very crudely, we look for kind of people, product and potential. People being, you know, is the founding team brilliant? And we've got kind of 15 criteria that we look for in our founding teams. Product is the company providing a powerfully better product to the consumer? You know, is it cheaper, faster, greener, more convenient? What makes it better than what is currently available? And finally, potential is this going to be a highly valuable and defensible business in the future? And ultimately, we're looking for businesses that will exit for more than 100 million.
I always think you should raise probably about a third to a half more than you think you need, because frankly, things always come up, life comes up, issues come up that you weren't expecting. And also raising money, and Kirsty can attest to this, raising money takes a long time.
For a seed round, we were looking to effectively prove that we could make a product that people would buy, which is, I guess, product market fit. And so that's what we were looking to do with the funding that we got at the seed round. I definitely echo Philippa's comments of I would always err on it could take longer to raise the next round, and so give yourself a little bit of headroom. That if things take longer, either from a product market fit perspective or a fundraising perspective for the next round, then you've got that buffer.
Valuation's a really tricky one. There's no rule of thumb. It's kind of as much an art as it is a science. And I think the first thing to realize is that, like any price, it's very subject to kind of supply and demand. So, you know, the best way to get a strong valuation and not give away much of your business is to have a competitive process and have, you know, several investors wanting to invest in your business. Now the second point I've made is it goes back to roughly what you need to execute your plan and to execute, you know, this kind of the next stage of growth of your business. And, you know, we typically look at about 20% dilution. Again, that amount of dilution can go up and down depending on the competitiveness of the round. So I think, you know, if you're writing your plan and you think you need X amount, what does that mean for your valuation if you take 20%? Now, often people end up with a valuation that is just not achievable at their current stage. And this often means they kind of need to slightly rethink their plan, or potentially think about raising the investment in tranches. So, you know, okay, I'll raise half of that and I'll prove half, and then I'll kind of go back out for the rest.
What revenue multiples would you expect to see in a valuation? Doesn't really work like that with early stage valuations, in that it's much more about, you know, you're looking at really what the potential of the business is, rather than just what the business is at the point that the investment is happening. One thing I do see a lot, particularly with actually, and obviously not Jamjar, but with some VCs looking to put money in really early stage, at the seed stage, when businesses don't even have any revenue, they're pre-revenue, and you will find some VCs that want to put money in, and the valuations that they ask are that they come up with are so low that they're going to end up with kind of 40% of the business on day one for not very much money at all.
You don't need to be profitable. I think we have invested in one business that was profitable at the point of investment, and that was a much later stage private equity style investment. What we want to see is unit economics that mean that the business will be profitable at scale.
Generally, the angels that we had on our cap table were very well connected. We're used to investing in our type of businesses, and opened a lot of doors and connections for us.
Is this a person that I can see getting on with and being able to work with in my business going forward, because they're going to be there for a while?
Whether it's an angel investor or a VC, definitely asked to speak to kind of another one of their investments, maybe if possible asked to speak to one that's gone well and one that's not gone as well, and just get an understanding from other entrepreneurs if they are actually, if they provide the value out that they say they'll provide, and on the flip side, if they're a right pain to work with, because then you want to steer clear.
Having VCs right from the start was quite unusual a while ago. Now it's a lot less unusual. There's lots of little funds out there who will invest quite small amounts of money in early stage businesses. VC terms tend to be, by their very nature, a lot tougher, a lot harsher than an angel investment term sheet. Angel investment terms tend to be more, you guys just get on with it, make it happen and make it work. I think you have to know why you're crowdfunding and, you know, the benefits of crowdfunding. And I think somebody asked it in the chat, but one of the benefits is the valuation you can get. You can get amazingly high valuations because, frankly, somebody putting 20 quid into a business doesn't care so much what the valuation is as somebody who's putting £200,000 into a business. So you can, you know, if your valuation isn't great, one way to make sure you get money at a better valuation is to go through crowdfunding. But on the negative side, you have to pay for it. You know, you have to pay the crowdfunding platform to put your business on that platform. And normally you have to have found between 50 and, in one case I saw, 90% of that funding yourself before going on the platform, but you will pay a percentage of all of it to the crowdfunder. If you're doing it because you want to advertise a B2C business to customers and get people invested actually as well as figuratively in your business, great thing to do. But if you're doing it because you want to raise £1 million, don't do it. One thing you can do if you're not comfortable with your valuation and you want to wait before you start to hand out equity is you could think about something like a convertible loan. So that's where you take lending from, for example, an angel investor. They lend you what they would lend you if they were investing in your business, but instead of investing in the business, they lend you the money. And how that normally works is there's normally a trigger point that says, if you raise more money or in 2 years' time or whatever it is, I, the investor, can convert this money into shares in your business. And that's hopefully at a point at which the valuation is better and therefore you're not giving away so much of your business.
The only other thing I'd mention would be grants, government grants, sector grants, charity donation, those kind of things.
Yeah.
If you hunt, then there's money out there, and it's a bit of work to get it, but so is raising money through the other routes we've talked through earlier.